Volume and market indicators. Imagine two identical price moves. One happens on huge trading activity, the other on almost none. Same move, completely different meaning. That difference is volume, and it is the first indicator every trader should understand. So what is volume? Volume is the amount of an asset traded in a given period, like 1 minute, 1 hour, or 1 day. Think of it as participation. It shows how many people are involved in a move. Volume also shows conviction. If price rises and volume is high, many traders agree with that move. That usually makes the move more trustworthy. But if price rises on very low volume, fewer people are supporting it. That kind of move can fade or reverse more easily. This is why traders often say, volume confirms price. Price tells you what happened. Volume tells you how strongly the market believes in it. Now let's talk about indicators. Indicators are calculations drawn on your chart to help you read the market. They take past price and trading data and turn it into something easier to understand visually. But there is one mindset every beginner should remember. Indicators do not predict the future. They summarize what has already happened, so you can make more informed decisions. That distinction matters. Indicators confirm, they do not predict. One of the most common indicators is the moving average. A moving average smooths out price into one flowing line. For example, a 50-day moving average takes the average price from the last 50 days and updates it continuously. Why does that help? Because crypto prices move around constantly. Charts can look noisy and stressful for beginners. A moving average removes some of that noise so you can focus on the bigger direction. If price stays above a rising moving average, that can suggest an uptrend. If price stays below a falling moving average, that can suggest a downtrend. Two common versions traders watch are the 50-day and the 200-day moving averages. Quick question. RSI measures whether a market might be overbought or oversold. What do you think happens when everyone has already bought? Think about it. The answer is coming up. Here's the idea. When nearly everyone who wants to buy has already bought, there are fewer new buyers left. The move can start running out of fuel. That's where RSI comes in. RSI stands for Relative Strength Index. It measures the speed of recent price moves on a scale from 0 to 100. Traditionally, above 70 is called overbought and below 30 is called oversold. But this is where beginners often get confused. Overbought does not automatically mean price will crash tomorrow. In strong trends, RSI can stay overbought for a long time while price keeps climbing. So RSI is best used as a context tool. It helps you understand momentum. It's not a buy or sell signal by itself. Now, let's put everything together. A simple beginner approach is this. First, use the overall trend for direction. Then, use moving averages to help confirm that trend. Use volume to judge conviction behind the move, and use RSI to see whether the move may already be stretched. No indicator works perfectly on its own, and adding 10 more indicators usually creates more confusion, not better decisions. Most experienced traders focus on a few tools and learn them deeply. So here's the recap. Volume shows conviction, moving averages reveal the trend, RSI gives context on momentum, and indicators confirm rather than predict. Follow us for weekly crypto education made simple. This content is for educational purposes only and should not be considered financial or investment advice.